Hello and welcome to Future Squared. Stephen Hawking once said that intelligence is the ability to adapt to change, so let's adapt. My name is Steve Glaveski, and each week I'll bring you conversations with preeminent thought leaders from a variety of fields to help you think in a multidisciplinary way, keep goals in your professional and personal life, and better navigate what is fast becoming a brave, new world. Future Squared is brought to you by Collective Campus, an innovation accelerator that works with organizations to unlock their people's latent potential to create more impact for humanity and lead more fulfilling lives. If you need help driving your organization's innovation strategy, visit collectivecampus.io. And without further ado,
come with me if you want to live.
Your cash flow is going to be tight. But if you can grow that business and build up all of that equity, I mean, your ROI is going to be unparalleled compared to any other investment.
Welcome back to Future Squared for episode number 322 with Walker Deibel. Walker is an acquisition entrepreneur. He has co-founded 3 startups and acquired 7 companies. He currently serves as the President of EDC, which helps companies with multiple locations manage their supply chain through sourcing, inventory, and fulfillment management. Walker is also the Managing Director for Centra, which currently owns and manages 3 companies. In addition, Centra is a partner in over half a dozen firms, covering distribution, manufacturing, education, childcare, film and television production, enterprise software, online content, and e-commerce. Walker is the best-selling author of Buy, Then Build, How Acquisition Entrepreneurs Outsmart the Startup Game, which forms the basis of our conversation today. He has also produced almost a dozen films and had premieres at some of the world's most esteemed festivals, including Sundance, South by Southwest, and Toronto International Film Festival. Listeners of Future Squared would have learned all about building new ventures from the ground up, but not as much on acquiring ventures with a foundation to build upon. So it was great to get some fresh perspectives from Walker on a topic I haven't explored in depth on this show before. We unpacked lots of lessons, including 1, when buying first makes more sense than building first. 2, how raising capital for an acquisition opportunity can become a virtual walk in the park when compared with raising capital for a startup. And 3, how to identify and evaluate acquisition opportunities. With that, I hope you will enjoy my conversation with the one and only Walker Deibel. Welcome to the show, Walker.
Thanks for having me, Steve. Really excited to be here.
That's an absolute pleasure to have you on the show, and you're joining me all the way from sunny St. Louis. Every time I hear the word St. Louis, I just think of this Simpsons episode where Steven Tyler's performing in Springfield, and he says, "Hello, St. Louis," and Joe Perry says, "That's Springfield, Steven."
St. Louis is one of these places where we get these bitter northeastern winters and these deep southern, humid summers. You can almost picture us, both in our parkas and eating fried chicken. It makes me wonder why anyone lives here. But
yeah.
It was the fur trade. It all originated with the fur trade. Now we've stayed.
Yeah, I imagine you had the chill come through a couple of weeks ago.
The what?
Well, it was the Arctic chill? I forgot the name of it. It's been a couple of weeks now.
No, I don't think it's lifted. It's still here. I mean, we're getting a wintry mix here today. I don't know what's going on. I didn't walk to work today for sure.
Fair enough, my man. Fair enough. Well, look, we can talk about St. Louis all day, but we've got some more important stuff to talk about around your new book, Buy Then Build, How Acquisition Entrepreneurs Outsmart the Startup Game, which has been out for a few months now. Man, there's a hell of a lot of noise in the entrepreneurial ecosystem today, particularly if you read publications like Mashable and TechCrunch. It's all about starting a business from the ground up. But the fact is, about 96% of startups fail. And that's because they're operating in conditions of extremely high uncertainty. Sure, there's the opportunity for a massive upside, but for every one home run, there's probably about 100 failures that nobody ever hears about. And you're suggesting that there is an alternative and better way to do this.
Yeah, Steve, I think that, as entrepreneurs, we're always told that, we start businesses because we, experience our own pain. And then, we kind of try to solve our own pain, right? And I think at the end of the day that, maybe I'm just a bad entrepreneur. But, that, like you said, it's we all know that startups fail. It's not new. But the thing is that, a lot of us have this belief that, maybe 10%, of startups kind of succeed. If you ask entrepreneurs that have made it, they tend to sort of pick a number even less than that, in my experience. And what you're pointing to is that, Vern Harnish came out with a book called Scaling Up, where he actually showed the statistics behind the fact that, only 4% of companies in the United States ever exceed $1 million in revenue. And what that did for me was kind of say, okay, wait a minute. Not only are 90% of startups about basically never succeeding, but then 96% of the ones that succeed never truly get that product market fit. They sort of live in this. I won't go as to say like, I won't go so far as to say, kind of like a Walking Dead or a zombie business, but it never grows beyond that kind of lifestyle business. And I've never met an entrepreneur who said, I started this business because I really wanted to generate 200,000 in revenue, and this year I'm going to generate 250. Like that's not why we do this.
Yeah.
So it sort of led me to discover that buying existing businesses and using them as a platform for growing, changing and growing my own business was something that made a lot of sense statistically.
Yeah, well, unless you're a solopreneur who's happy just building a lifestyle business where you're making $200K a year, if you're building a business with employees, then that's definitely not going to be a fruitful opportunity. But I mean, you talk about acquiring businesses, and you talk about, you joke that you're not a good entrepreneur, perhaps building businesses from the ground up, but you have done both, and you've built 3 businesses and acquired 7. I mean, how have those experiences been different, and in what fundamental ways were they different?
Yeah. So, let me give you the headlines. Like basically, I've co-founded 3 startups. Let's just take sort of the biggest here, which was, what we did was we developed a enterprise level SaaS product, right? And it basically was, a SharePoint infrastructure on the iPad. I won't go beyond that. We recruited the SharePoint consulting division head from Microsoft to be our CEO. We raised all of the capital and became oversubscribed. We went through one of the top 10 accelerator programs in the world. We had beta programs at half a dozen very recognizable companies. We had a proven dev team. I could go on. I mean, this was, the bench was stacked. This startup was not going to fail. Well,
I see where this is going.
Right. 9 months later, we were completely out of cash. I'd basically not wasted, but, I lost some of my invested capital. I, wasted a year of my life. And it was about that time that, a business broker who had helped me exit my first business that I had actually bought, right, called up and said, Walker, how's that startup going? And I said, oh, Gary, it's pretty rocky right now. Here I am leading a reorg in a business with, 4 employees. But he said, good, because I've got a business down here that it's going to be a great fit for you. You need to come take a look at it. And so, every single time that, I try to start a business from scratch, whether it's a solopreneur kind of activity where, I'm trying to kick off a blog and gain momentum in my own on a room, I can never quite get there. And then whenever I'm, raising capital and doing these big projects, they don't get there either. So, I've kind of done the spectrum. And what I realize is that, the first business I bought it with a loan based on, the assets of the business as a collateral, paid it off over several years, and then, ultimately exited the company while trying to grow through acquisition as well. Yeah. So it was something that I saw worked for me. And so, once I kept having these startup failures, I decided to go back and kind of try to perfect the model that I was getting success in.
So before we deep dive into the acquisition side of things with that SaaS business, the SharePoint SaaS business you mentioned. How much did you guys raise?
$750,000.
Yeah, and
So not a million, but
not a lot, but not a small amount either. And I think
that's right.
Sometimes there is a temptation for entrepreneurs when they raise that kind of coin to hire a team and spend a lot of money on marketing and development and everything else. And you could have a great team or a great product, but sometimes the market just isn't ready for it.
It's one of these things where we could have, done all the things. We could have, raised more capital, pivoted, there's all the users loved our product. The problem was we had to roll out, in my opinion, we had to roll out at the enterprise level. And so we were needing, CTOs to basically stop what they were doing and help us, get us access to their servers so that we could, change the way that their entire company was functioning. That turned out to be too big of an ask for too lightweight of a product, right? That's a pretty fundamental thing that we didn't get right. The thing is we would have gotten it right if we had more capital or pivoted to a different type of model. There's always ways to fix it. But the point is it's simply one example. Like if you look at venture capital backed, startups, this is sort of like the major leagues of startups, right? So we say that, 1 out of 10 startups, bootstrap startups say are gonna succeed, right? Mm-hmm. Well, only 25% of VC-backed startups don't go to zero. Think about that for a minute. Yeah. 75% fail, and the average amount of capital raised is like $67 million.
Mm-hmm. Yeah, I've seen those statistics. It's crazy. Like 75% of even Series G startups fail to exit.
Right. So the point is, whether we raised $750,000 or whether we raise 65 million, the stats are the same, right?
Yeah, and the likelihood of a VC-funded startup to reach that unicorn status, those billion-dollar valuations, is something like 1% of a VC-backed startup.
Yeah, right. A VC-backed, right?
Yeah,
exactly.
VC, that doesn't even include the startups who are angel-backed or just managed to raise some capital or bootstrap themselves. So that brings that number back down to something like arguably 0.001% or something to that effect. But so I think that's a really good point to call out, because you can do everything right. You could have the head honcho from Microsoft. You can have a great dev team. You can have all the cards stacked in your favor, and things could still not work out. And that's something that a lot of entrepreneurs building businesses need to be cognizant of, that there are so many variables that determine whether or not the business will be successful that you're probably not privy to until you go on that journey. So while it might look like a sure thing from day one, sure things are very rarely that.
Well, and Steve, let me jump in here and say that, there's, even if you look at some of these like iconoclastic entrepreneurs, right, that we all sort of worship, sort of like Elon Musk today is probably, reached that epitome, maybe Jeff Bezos a little bit. Let's look at Elon Musk for a second. There's a couple of things that we all absolutely know for sure, right? Which is, number one, Elon Musk, co-founded PayPal. Okay. Number two, he co-founded Tesla, right? These are things that we just know. Mm-hmm. Well, he actually acquired PayPal when his startup X.com failed. Yeah. He actually acquired Tesla. He was the big investor in Tesla that two other co-founders started. Now, he came with all the capital. He was still there early, right? He grew the business. Yeah. But at the end of the day, he's an acquisition entrepreneur.
Yeah. He likes to think of himself as the co-founder of Tesla, though, although the original founders seem to disagree.
One of them sued him, I believe.
Yeah.
Right. And even Bezos, like I like to think about, we all sort of get to the point where these great entrepreneurs, they get to a point where, they exit and then they go off and they become VC, or investors or whatever, or they get to a point where they're so big, they also start doing acquisitions. So, even just looking at, Amazon's recent activity. Jeff Bezos personally bought the Washington Post. Well, why didn't he just start his own newspaper? Yeah. Because it makes sense to buy it, right? And now he's buying Whole Foods and, there's rumors that he was trying to buy Target, et cetera. So it's a great way to grow. So why hasn't anyone started talking about having it be a great way to start?
I guess it's perhaps not as sexy on the surface, and that's perhaps something that our media in this space need to do a better job of reporting on. But Speaking of CEOs, something I like about your book in the sense that it kicks off talking about things like the CEO mindset, around attitude, aptitude, action. I mean, what kind of mindset does someone really need to have, in your opinion, Walker, to acquire a business and take it from, say, 0 to 1, to quote Peter Thiel?
What an awesome question. Okay, so, in my opinion, people, they really need to have two things. Number one, they need to have drive, because if they're not motivated to get this done, the businesses don't just run themselves. We all know that. And a lot of times, I was pretty well established in the entrepreneurial environment here in St. Louis, maybe even the Midwest, and once I started buying companies and trying to grow them, I would be introduced from one entrepreneur to another one as, oh yeah, this is Walker. He buys and sells businesses, and it's like, huh. That sort of sounds very like Wall Street to me. Like, I'm not really a Wall Street guy. The whole point is that I'm buying these companies and then I try to build them. I'm an entrepreneur just like you. You know what I mean? And so you've got to have that drive in order to build these companies. The second thing is you really need to have a growth mindset. So, Carol Dweck really was the one that really got her arms around and coined this term. And, the whole point is, kind of having that relentless solution focus and knowing that, you are capable and able to be able to solve any problem that kind of comes your way. So if you take that and couple it with drive, I mean, those are the things that truly make a successful entrepreneur.
Yeah, couldn't agree more. And I think that growth mindset is absolutely critical, because entrepreneurship is plagued with all sorts of pitfalls that you can step into and all sorts of setbacks. And if you've got a fixed mindset, or if you're not comfortable with your ego getting trampled on every now and again, then you're going to quit at the first or second sign of adversity. But hey, if you've got a growth mindset, you'll appreciate that it's just part of the journey and you'll keep moving forward. But with respect to guys like Bezos and Musk, obviously, when Musk purchased, say, Whole Foods, he already had a lot of capital to play with. Now, if I am a early stage entrepreneur and I don't have that much money in the bank and I'm looking to perhaps take a leaf out of the Walker Deibel book, what will I do? I mean, obviously I can take out a loan and use the collateral of the business assets against that loan. But I mean, how much should I be bringing to the table of my own capital if I am looking to buy a company as well?
Yeah, that's great. So Steve, it's almost like I almost didn't release the book, right? I mean, it took me 3.5 years to write this thing, and I almost didn't release it because I feel like, I sort of am showing the way for someone to, totally screw up their life. But let's just start at the beginning and then we'll kind of wade in if that's okay. Ultimately, if you compare, trying to raise capital for a startup, okay, to trying to, get capital to acquire an existing business, it's so much easier to get out from the United States, in my own experience anyway, by the way, right? So it's so much easier to get capital for an existing business. There's a few reasons why. Number one, the valuation of the company is based on a multiple of existing earnings. Okay. So in other words, when you look at a startup, it's like, hey, today the company is making zero. We're valuing the company at, $2 million. And so, if you give me, $1 million, you can have 50% of the company that has a zero earnings. That's like your margin of safety is like zero. Okay. Whereas when you look at an existing business, that investor is going to look at it and say, oh man, like a 3-year payback on earnings that have been there for 10 years, all day long, I'll invest in that. Right. Yeah. So, it's much easier to get capital. Second, banks lend on that. So, I mean, there's assets there, there's historical performance there, there's existing customers there, there's all of the infrastructure that we as startup entrepreneurs are trying to build with that initial capital, right? So your question is, how much money do I need to bring to the table? Well, look, I mean, there's a trend in something called search funds, right? And search funds basically enable acquisition entrepreneurs to raise capital from private investors, just like angel investors, okay, and create a fund that will basically support them in their search and in buying the business. Okay. So in these instances, these acquisition entrepreneurs with search funds are actually not bringing any money to the table, and they're getting paid while they're searching. All right. Now, this is not a widespread practice. It's really heavy up in Chicago and coming out of Harvard, but it's not something that has really picked up huge momentum outside of those sort of niche marketplaces. However, in terms of someone who wants to kind of go it alone, I'm not going to lie. The more you have, the better. Okay, yeah. It's true. But because of the access to capital, the SBA here in the States is allowing entrepreneurs to lend up to 90% of the acquisition price on a business. And so they would need to bring up only 10% of the total amount that they would need to buy the business. They can also only bring 10% to buy any inventory, any additional working capital, any closing costs associated with the loan, and if you're so inclined, the real estate associated with it as well. So, in terms of the capital you need, you really don't need that much. I think in the book, I kind of parallel, look, with a $65,000 down payment, this is the average down payment for a house in the United States. That's a very similar amount of money, right? Within like $2,000 of that, you can actually acquire a business that is already exceeding $1 million in revenue, which, as we've already talked about, is one of the top 4% of largest companies in the United States, with the same amount of money that you can buy a house with. I'm not suggesting that everyone should go out and buy one of the largest companies in the United States, but maybe most people should be considering it. Yeah. Maybe most entrepreneurs should be considering it, right? It's such a head start.
Yeah, well, if you're only putting in 10%, and something you talk about in your book is that 80% of businesses transact for less than $1 million US dollars, that would suggest that you can get in on 80% of deals for, say, less than $100,000 of your own money.
Yes and no. Okay. A lot of banks don't want to lend below, say, $500,000. I mean, like a $500,000 transaction is really small for a bank. Some of them will, but if you want to, but yes, your point is valid. I mean, especially if you've got access to, additional, friends and family who might want a piece of it. You can definitely get in for less. Yeah, sure.
So a lot of people listening to this may be, say, debt averse, and the idea of taking on debt, whether it's theirs or their own, whether they're working with a search fund or not, may make them somewhat uncomfortable. But something you talk about in your book is stress testing your loan, which is such an important point. Can you please elaborate on that one?
Yeah. So let me first please pull this around to, I said I almost didn't release the book. It's because I feel like someone's going to read my book and say, oh my gosh, look, I should go buy a business and, leverage it up to 90%. And then they're going to go buy a business that, either they make a bad decision or they kind of fail to run it or whatever. And, you can't go out and just take 90% debt on a business and view that as not risky. Okay. But when you go raise capital and say, hey, give me $1 million and we're going to go build, or give us $750,000 and we're going to go build this thing and do it. That 750 went to zero. It just wasn't the entrepreneurs, right? So in this case, it's yours. You're responsible. Okay. And so the thing is that the private equity industry has been doing, leveraged buyouts in a very similar model for decades. And they've learned twice. I'm sorry, I'm forgetting the second time, but in 1987, and I'm sorry, I forgot. But they've learned twice that it's a lot better to put more money in than the absolute minimum. So if you're just getting started, or you really just don't need access to, sorry, let me say it this way: if you're just getting started and there's just no other avenues to go, and it's a good opportunity that you can succeed at with your individual skill set, then, you're going to be able to grow that business. And once you grow it, that, principal and interest payment becomes a smaller and smaller percentage of the cash flow of that business.
Yeah. And I imagine then the risk appetite profile that the entrepreneur has will inform the type of company profile they go for, whether it's a high growth or potentially an eternally profitable company, as you put it in your book.
Yep. Yeah, absolutely. And the other thing is I've got a return on invested capital calculator on my website, Buy Then Build. And if you go there, you can kind of see like the safety risk sort of balance. And you'll see an even graphical form looking at that calculator that, if you put down between 40 and 60% of, the price of the business, you're like really safe and you're getting all of the benefits of ROI that leverage provides.
Yeah.
So, if you put down 10%, your cash flow is going to be tight. But if you can grow that business and build up all of that equity, I mean, your ROI is going to be unparalleled compared to any other investment. It's just that, things can get tight there. So you got to be careful.
Yeah. Well, we'll add the calculator to the show notes for our listeners. One thing we hear about today quite often, and if you read books like Drive by Dan Pink, is on the science of intrinsic motivation rather than just extrinsic motivation, which is not so much about making money, but also about purpose, mastery, and autonomy. And, when someone picks up your book, they might immediately think, oh, well, this guy's just about making money. He's not about purpose or anything like that. But you do talk about Jim Collins's hedgehog theory in the book.
Wow. I'm sorry, I've got to put those two things together. What a great two dots that you put together. Yeah. So I think, Steve, what I would say is that, I think that, yes, a lot of people, like earlier you said, hey, maybe the startup world is more sexy or something like that. I think that a lot of times people will look at, buying an existing business and say like, oh, well, that person isn't creative. Mm-hmm. They're not passionate about it. Right. What I'm going to say is, there's a good friend of mine who started many companies here and in St. Louis. And he said to me once, he said, Walker, what I have found, he's in his 50s. He said, what I found over my career is that when I start a business that I'm really passionate about, but I can't get that product market fit, and I'm spending money and I'm losing money and it's not working, I find that I lose passion really fast. And, when I start a business that, it starts, I'm sort of, okay, but I see the opportunity, but I'm not that passionate about it. But then it takes off and it really starts working. I start making a lot of money. It's real easy to get passionate about it. Right. What I would say is when you are looking for a business to buy, one of the going back to your stress test, it's almost like one of the things that you need to be able to do is ask yourself, like, all right, if I'm at a cocktail party and someone asks me what I do, is this something that gets me excited, right? Mm-hmm. And I think part of, finding the right business for you is finding, that growth opportunity that matches your existing skill set. And it's in a space that, you either have an original idea that you want to launch and it's got an existing customer base that wants to buy it, or you find that company that, sort of, matches your target statement and has all of these things that you're looking for. And you're like, wow, I can make $150,000 doing this right out of the gate, even at 90% leverage, and I'm only going to bring 65 grand to the table. I mean, not only do the economics work, but it can be really easy to get excited about that, right? Yeah. Once you start using the cash flow to start building your own company, you form this company to your passions and your drive, and it becomes in your image, okay? And Jim Collins's hedgehog concept is simply, the good to great companies have, they ask themselves, okay, what can we best in the world about? What can we be best in the world at? Mm-hmm. What can we be passionate about? And what drives our economic engine? And when those three things intertwine, this is when companies go from good to great. And as an acquisition entrepreneur, always keeping, the intersection of those things in mind is what's going to help you find the right company for you and the right growth opportunity for you as an acquisition entrepreneur.
Yeah, and that be the best in the world at piece, I think, is so critical, because it's easy to look for something that makes money that you're passionate about, but perhaps it doesn't really align with your natural strengths, inclinations, your past experiences, your networks. And therefore, you're probably not going to be anywhere near as effective in that space as you would be if you did find something that aligned with those particular attributes. And then you see results. And when you see results, that feeds back into your motivation to keep doing it, like you said.
I love that. You've experienced the hedgehog concept in your business, Steve?
Oh, definitely. Yes. I mean, I've founded startups where I wasn't really aligned, and the results just reflected that. And then I founded startups whereby there was alignment across passion as well as my natural strengths and inclinations, and it also made money. And once you see results, it's much easier, like you said, to not only get passionate, but stay passionate about the business.
Right. And Steve, I also like I think, just in being around entrepreneurs for, basically my whole career, what I've learned is that, when Good to Great first came out, I mean, I've read this book more than any other book, right? I mean, I love it. It's so good. And I thought like, oh man, this is like the Bible of business. Like there is no other way. Mm-hmm. And in being around so many entrepreneurs, I've learned along the way that not everybody is a good to great, sort of builder. And that doesn't mean that they don't build great companies or do their own thing. Like there's so many different flavors. But to your point, that hedgehog concept really rings true in almost every circumstance. I mean, if you can get those things right, I mean, that's a very special opportunity.
Yeah, couldn't agree more. So Walker, I mean, your book puts forward a number of different factors I would look for. Say I'm at that point where I'm open to this. I want to identify businesses that I can invest in. But before we get to brokers and things of that persuasion, I mean, how do I effectively go about determining whether I should buy a business? I mean, there are obviously things like the valuation of the organization, whether they have any, say, intellectual property, the health of the business today in terms of their balance sheet. We've talked about alignment to one's strengths and passions. I mean, what sort of key factors should one be considering?
You mean when they're looking at a specific opportunity or wondering if they should be doing it themselves?
When they're looking at a specific opportunity.
Okay. So, number one, there's a couple of things that I repeatedly go to. Mm-hmm. The very first is going to be, just textbook Porter's 5 Forces, right? It's one of the ways that it's one of the best tools that I've ever found one of the best frameworks in order to just sort of look at a business and understand like, okay, where is the strengths and weaknesses of the business model, right? You can look at, is there supplier power? Is there consumer power? What's the threat of entrance? And if you just do a complete analysis, of all of those things in the industry, it's going to tell you a lot about the opportunity that you're looking at. Mm-hmm. Let's see. Number two, I love looking at the innovator's dilemma. The innovator's dilemma was made by Clayton Christensen and at Harvard, and it basically talks about it talks about new emerging technologies mm-hmm. and existing technologies, and understanding where the business is in its life cycle, and understanding where the technologies are shifting will kind of point you in the direction of where the trends are coming from, where the trends are going to be headed under your leadership. And in my mind, trying to capture the new trends are the things that ultimately is going to make the leap. Every entrepreneur is going to have a business challenge where they've got to lead the company into a new way, that matches the trends of the industry. So trying to get an understanding of the undercurrents of those types of things is something that I frequently look at. Yeah. Maybe either the last thing or the first thing is sort of the AE matrix that I outline in the book. Is that maybe what your question was to begin with, and I just missed it?
No, it was very much an open-ended question, but go for the AE matrix.
Sure. So the acquisition entrepreneurship matrix is just something that, it's something that I came up with that every time I'm looking at a business and trying to figure out, okay, like what am I looking at, right? I mean, there's mm-hmm. different opportunities that acquisition entrepreneurs have. The first one is truly come out of Harvard, if you ask me. It's that eternally profitable business. That's sort of like snowplow business where there's no, it's been going on for years. The roads will be there for years. There's no technological, threats to, a commercial window washing, business, for example, right? But you're also not going to get that big growth. Like it's not a lot of risk at all. It's very safe, but you don't get that big growth. Next would be sort of that, that growth business, that one that's just, it's just growing, somewhere above, 30% year over year for a number of years, or, it's just doubling every year, whatever it is. It's that SaaS business that's easily scalable and just kind of exploding. It's almost the opposite. Like as long as you keep that growth going, it's going to really work out. And so as long as that matches your skill set and you feel comfortable with it, it's great. They tend to look very attractive to, first-time buyers. But the truth is there's sort of an underlying risk there, which is those businesses demand a very high price tag. So, you can get stuck if that growth doesn't continue. You've got the turnaround, something that's a really underperforming asset that you can jump in and use your skill set to sort of, dust off, some underperforming assets and grow it to their full potential. And then you've got what I call the platform company. This is a company that technically could be in any of the other quadrants, but what it does is the growth opportunity of that business matches your skill set and what you can bring to the table. And if you find that right platform company, you're going to be able to both have that safety and have that growth. Because in any investment, it's not necessarily the investment that has the intrinsic risk, but the investor. And so by finding that platform company, you're de-risking the acquisition by aligning the risk and the growth with you as the entrepreneur.
Yeah, that makes sense. I guess with whether it's a high growth company, a turnaround, or a platform, for example, when we are looking at the value of this organization, I mean, there are so many different ways you can value a company, whether it's fair market, liquidation, cash flow based, asset based, and so on. I mean, in your experience, Walker, do you normally try a few of these models and then kind of wash them against each other to come up with a number? Or because sometimes one mechanism can come up with a radically different valuation than another one.
Okay. Let's see. How would I say this? I think that, I'm at the point where I think I've just been doing it for so long. I've got a pretty good feel for it.
Right.
And, it's one of these where, I was a licensed stockbroker. I am a certified M&A advisor. I value companies every day of the week today. And, so it's something that I guess I just know how to do. So, so there's two things that are going to lay the foundation for a business valuation, and that's growth and earnings. Okay. So number one is, what are the earnings? And it's sort of like, okay, is this company making $5, 500,000 a year? Is it making 5 million a year? Is it making 50 million a year? So, the different sizes of companies are going to move you into different, multiple ranges, so to speak. Then you've got growth. So for example, if I sold $1 million in revenue last year, but the year before I sold 500,000, I'm growing 100%. Well, that's going to push pretty north, right? In terms of what that size business can sell for. On the other hand, if I sold, 2 million the year before and now I'm selling 1 million, well, that's obviously going to kind of drop the value of that company, right? So it's sort of like, what is the trend of that company? From there, there's something that, Mark Doust at Quiet Light Brokerage calls, the 4 pillars. And you sort of get into what's the business risk that the buyer is taking on? What is the transferability of the business? What is the verifiability? Like, what's the third party verifiable quantitative data, and how good are the financials, and how do they match the tax returns and all that kind of stuff? And then there's the growth opportunity. And so, I think that if you take all of those things into consideration, and then, also sort of get a sense for, comps in the market, you'll have a pretty good sense of where the business is in terms of, the kind of size businesses we've been discussing on this podcast. I'd say that just to give you a really big range, if you took like a seller's discretionary earnings, I don't know how technical you want to get, but if we took an SDE and multiplied that, which, think of it like this, SDE equates to the total cash flow of the business that is available to the owner. And that's for, principal and interest, that's for reinvesting, it's for salary or whatever, right? Whatever you want to do with it. And you multiply that by 2, or you multiply that by 4. That's a pretty both big range and a pretty tight range compared to the size of companies we've been talking about. So in other words, a 2 to 4 year payback, or something like that. Yeah.
So, and you consider the growth rate based on not just the previous year, but maybe looking at the past 3 to 4 years.
Yeah, it's going to depend on, it's funny. It kind of depends on the type of business you're looking at. Like, the more bricks and mortar businesses, you definitely want to be looking at the last 3 to 5 years. A lot of times you'll want to weight it. So, the prior 12 months is going to have more weight than, 3 years ago, for example. But in, online businesses, for example, the the landscape changes so frequently and so easily that, there's a lot more weight given to, the trailing 12 months and sort of the year over year comparison, just because that industry is so flexible, right? That it's really hard to look 5 years back on an online business and really give that any meaning.
Yeah, that's exactly right. And
right.
With respect to decision making, whether it's valuations or something else, I mean, something hedge fund manager Ray Dalio talks about is a meritocracy and surrounding yourself with believable people. And while you may have an opinion that you've come to through a combination of your own professional judgment as well as data, having that challenged by 2 or 3 other people who you trust, and then coming to a common consensus on the back of that is something he advises for. Is that how you approach things in your businesses?
I love that. I think that, yes, I guess over time, I didn't realize it until you just said that, but yes, I've got a few advisors that I absolutely look at every deal with, and I didn't really think of it the way until you just posed the question like that. Yes, absolutely. I've got people that know the space, know the industry, people I trust. That whenever I'm looking at a deal, I absolutely would show it to them and kind of pitch it to them. So yeah, getting buy-in from other people is something that I look for. Yeah. And, more importantly, I mean, they it's like shoot holes in this. Like I'm making an investment here. This is a life decision for me. A big part of that kind of branched out of the Entrepreneurs Organization and just having, that sort of confidential forum that comes together every month, and you can, sit with people every single month and talk through business issues and business opportunities. Absolutely. I mean, what's that saying, Steve? It's like you're the average of the
5 people you spend the most time with.
People. Yeah, exactly. So, absolutely.
Mm-hmm. Excellent. Okay. So someone listening to this, they're on board. They want to acquire a business, but they don't know where to begin, where to find these organizations, these acquisition targets. One thing you say in the book is not the internet.
Yeah. Okay. Here's the thing. I think that, here's why. Number one, people, it's like 90% of people that actually start out looking to buy a business never actually pull the trigger on a deal. And I've got a theory as to why. Number one, they're tire kickers. Okay. They're not really going to do it. They're not committed. It's sort of like if you've ever been in a meeting where, you're sort of like pitching, a startup investment to a potential investor, and they're just sitting there and they're totally negative and they're shooting holes in it. A lot of people who are trying to buy a business take that approach when they're going to buy a business. Well, this seller isn't trying to pitch you a startup. Right. It's like, here's my life's work. It's like on the block. Here's the earnings. Like, I mean, it's not that kind of thing. And so a lot of people, they don't know what they're looking for. They throw it too wide of a net. They work without a sense of urgency. And I've met with potential buyers before who, have hired me to consult them and then figured out that they were actually standing in the business they should have bought. It was biting them in the leg and they didn't realize it. Okay. So it's like they're just sitting there like trying to make excuses not to actually move forward because they don't know what to do. They have no framework. Right. So they don't know what they're looking for and they're working without a sense of urgency. Like if you have a deadline and you set a date and you say, okay, I'm going to be CEO of a company in 6 months. Okay. That at every step is going to force you to ask yourself like, okay, what needs to be true at this stage for me to move forward or shoot it down? And as long as you're pushing yourself to come up with a real yes, a real no, or real next steps every time, now you're a real buyer. Okay. Number two, if you go online, do you guys have like Monster in Australia? Like
the
Monster.com?
job boards?
Yeah, the job board, career builder, and this kind of a thing.
Yeah.
It's one of these, Steve, where, I don't know your experience. All the jobs are there. Okay. I mean, sure, you go there and it's like there's endless pages of jobs. Okay. I've never met anyone that's actually gotten a job off of one of these sites.
Yeah. It's usually about being in the know and knowing the right people and being targeted rather than
That's
looking
it.
for it. Yeah.
And so there are these websites like, Biz Buy Sell or Flippa or whatever. And the thing is with these online marketplaces, they tend to sort of, lower themselves to the lowest common denominator, and they all kind of look the same. I'm not saying that it's all bad deals. There's good deals on there. Okay. Maybe, I don't know, pick a number. 10% of those deals are good. 10% of those deals are good for any individual person. It's not the same 10%. I don't know. But the point is all the junk is there for sure. Okay. So you become numb and you don't know what you're looking at anymore. So it takes someone who, doesn't have a target statement, hasn't gone through, the prep funnel, doesn't have a framework. And then they just sit there and they sort of wait and, 80% not a fit for them, 90% not a fit for them. And they get burned out and they don't know how to move forward. So if you've got a strong target statement and you've done all the prep and you've got a sense of urgency, I do say use those sites, okay? But use them very sparingly. Get on, get off. Look for exactly what you're looking for and get off that site. The real trick, Steve, is getting your own deal flow.
How do we do that?
Yeah. So that's where, it's basically if you're looking for an online business, go find those online business brokers that are working in that space, get on their list, get those new deals coming right to your inbox. Okay. Watch them, look at them, find out, spend a few months just looking at every deal, figuring out what it is that you're looking for, watching how fast certain properties move. You'll see it. If you're looking for an offline business, Google, business broker, intermediary, M&A advisor, investment bankers, whatever in your geographic area. Go meet them. Take your personal financial statement. Take, your resume. Explain your target statement, what you're looking for. And don't leave that office without getting on their email list, okay? They all have kind of a menu of, the businesses that they happen to have listed right now. But you have to understand that when you're looking for a business for sale, the last thing the seller wants is people to actually know it's for sale. It's veiled in opacity, right? I mean, you've got to sign, non-disclosure agreements at every step of the way. So it's opaque, it's fragmented, and so you've got to find the people in your neighborhood that are getting that deal flow to them and start conversations so that they are thinking of you when those deals come up.
Yeah, that's definitely if you want to get in on the 90% of deals that aren't on your job board type of sites, I think that sounds like the way to go. So if we have identified companies through a broker that we're keen on having a conversation with, and we have sat down with the seller of this organization, I mean, what sort of thing rather should we be looking to glean from the seller as to why they're selling the business?
Okay. The number one question that buyers have, especially first-time buyers, is, why are they selling? It's a legit question. We need to know the answer. Okay. But, if you put yourself in the seller's shoes for a minute, here's what happened. Okay. Let me paint this picture for you. You start a business. You do the grueling work. You and I know how hard this is. Okay. You get it off the ground. It's now succeeding. You're eating ramen noodles. You get it off the ground. You start making a salary. Okay. You start buying some nicer clothes. Okay. It grows 100% the next year. Okay. You get some more customers. It's working. You get product market fit. It's working. You grow another 100%. Then you grow 50%. Okay. And now you've grown your company to, let's just say $1 million, $1.2 million, $1.2 million. And then all of a sudden what happens is it only grows, 10%. You say to yourself, okay, growing 100% is exciting. Growing 10%, maybe I've sort of done what I can do in this business. Maybe it's kind of time to move on. Not only that, but like the thrill of that acceleration from 0 to 100 is huge for an entrepreneur. And once it starts feeling like it's kind of leveling out, they start saying, okay, I'm not getting that same growth. If you're an entrepreneur, you kind of start to look around. You get a different idea. You start to change the direction that you want to go as a person. You start to lose interest. Okay. And it's not because you've got a piece of junk company that you're trying to unload. It's because you've lost interest. Okay. You've built something of value. Maybe you've spent the last years building something. You've reached one of the largest 4% of companies in the United States or the world. And, it's just time. That's it. So, yes, sometimes you get like, death, old age, sickness, whatever. These are sort of like the magnum opus sort of reasons. That word doesn't make sense there. These are sort of like the greatest reasons, right? That like buyers are like, oh man, I'm so happy that person died, and now I have an opportunity to buy it from the widow, or whatever. That's just a clean, I love the reason. It's just as valid to say, like, I built something of value over the last 5 years and it's time to sell because I want to, move to Nepal. There's no difference. It's okay,
Yeah.
So
I totally get that. I can see that, having been an entrepreneur for a number of years, how people just kind of lose that passion for certain things and it's time to sell. But I guess it's also about being smart and not waiting for that 10% growth rate to kick in, because then you'll basically be, arguably, based on what we talked about earlier, selling at a lower valuation than you would if you were still growing by, say, 50% a year.
Yes and no. In other words, it's really hard for, let's just pick a number like 20%. It's really hard for an entrepreneur to sell a company that's growing 20% every year or higher. And the reason why is because it's like it's really hard to figure out. It's like, wait a minute, I'm going to sell this for, 3 to 4 times earnings. Like I'm going to make that in the next 3 years. I'm going to make more than that in the next 3 years anyway. Like, why wouldn't I just keep it?
Growing.
Yeah. I mean, when you're growing 20%, I mean, you're hauling, right? So, if you've got a business that's growing, 8 to 10% every single year, that's a very solid business. It's also, as you start to have other interests and have time to move on, it's not so much that, getting a proper valuation and saying, I'm ready to move on, selling it for, taking 3 years worth of what I would get out of this company, today in cash makes a lot of sense. It just does. And as an acquisition entrepreneur, if you kind of backtrack to our conversation, let's say you only put 10% down and you've got 90% leverage, as you build up that equity over the following 10 years, your equity in that company is actually the growth rate is going to mirror exactly what that prior entrepreneur experienced. Did you follow that?
Yeah, like totally.
Growth and equity, actually, even if the revenue stays exactly the same, your growth and equity is going to actually it's going to go from 10% to 100% over the next 10 years.
Wow. Yeah, I think that's a key takeaway for listeners to bear in mind, and one we'll stress in the show notes. But when you do acquire a company, and do you have a temptation, or at least, let me rephrase that. I mean, what a lot of private equity firms do is they'll set up non-compete clauses, and they might keep the original founder on board for a, say, 18-month period or something to that effect. Is that something you vouch for, or is it really a case-by-case basis kind of thing?
It's definitely case by case. I think that the larger the company, the more likely the prior owner is going to stay on for a while. I think that so here's the thing. It's kind of like, most people, when they buy a business, they sort of, especially first time buyers, they think to themselves like, well, okay. Oh, let me say it like this, Steve. There's this, I didn't make this up. Someone said to me once, they said, okay, the buyer before the sale has, all the money and none of the knowledge, and the seller has none of the money and all of the knowledge, right? And then after the transaction, the seller has all of the money and all of the knowledge, and the buyer doesn't have any of the money or any of the knowledge. Okay. And so we all think like, I'm not going to have any knowledge. Like how does this work? Right. And so that's what we're trying to address, right, with keeping that person on. And in my experience, you want to, this is just how you want extensive access to that seller for the first 30 days. But then after that, I think that you'll be surprised how little you need them. And not only that, but especially if there's like employees involved, the employees start to not know who to go to, right? I mean, it's like, well, I reported to her for 15 years and now I'm reporting to you, but she's still here in the building. And when we bumped into each other in the parking lot, we accidentally had this like management decision that was made. You know what I mean? And so it starts to work against you to have that person around, and they're so checked out. They're so checked out because their asset that they built and grew is no longer theirs. And so, in my experience, you really want to kind of transfer all that knowledge as fast as possible so that you can run, your new asset. Yeah, you bought the business. You now own the business. You need that knowledge as fast as possible. You need that person accessible, but the whole reason you bought it is so you can use your own skill set to grow the company. So
I guess addressing that information asymmetry would be a big part of helping you establish yourself as a CEO, which is something you talk about in the book.
Yep, that's right. That's absolutely right. The other thing, though, that I would say, Steve, is once I started doing this, I started trying to ask myself, and I didn't really get into this in the book, but it's sort of like, how do I scale acquisition entrepreneurship? And what I discovered was that I could buy multiple companies, and instead of and then I could put managers in them. Okay, so instead of paying myself to go in and run it, I would then pay a manager to essentially run the business.
Right.
And so I to those businesses, I've got a couple of them. It's more like, I'm 42 years old. I don't have a lot of gray hair, but I act as the chairman of these companies. Okay. I'm in there on a monthly or quarterly basis. Okay. I'm at the strategic level. I'm really not in there working in the weeds or even solving day-to-day problems. And that's how I've managed to start scaling acquisition entrepreneurship. And by doing it like that, it's like I'm removing the owner that was in there before, and I'm putting in someone that I know can grow that company to the next level. Okay. When you buy like a middle market company and like you want to, keep the existing, when I say middle market, let's just pick like 50 million in revenue. Mm-hmm. If I'm going to buy that company, okay, and I'm gonna put in whatever, a small amount, 100,000. I'm gonna go get 5 million of SBA. I'm gonna get a traditional loan for whatever, and then throw some mezzanine debt on it. And then I'm gonna get and then I'm gonna go get the ownership team the management team to each buy in at 5% or whatever. I'm making it up, but like, you can get this done. Actually, it's actually much more approachable than you think. But the point is that like, if you're doing something like that, you want that whole management team in place. You want that maybe former owner in place so that they can kind of run the business, right? And for someone who's got like 50 million in revenue and they're trying to sell their business, that's going to go at a 5 or 6x multiple. And some financial buyer, meaning some acquisition entrepreneur with $100,000 is very unlikely to give that person the exit that they're needing, in one day. So they need to start taking bites of their apple. Mm-hmm. And that's typically when you see, the owner or former CEO staying on board and involved.
Excellent. Well, in the couple of minutes we have left, Walker, I wanted to just throw you into one of our lightning round questions, which is just around daily rituals and routines. I mean, not only have you built 3 businesses, acquired 7, written a book about it, you also have produced a number of films, a dozen films, in fact, that have had premiered at some of the world's most esteemed festivals, including Sundance, South by Southwest, and the Toronto International Film Festival. What do you do to stay on top of your game?
Okay. The truth is waking up early.
Mm-hmm. How early?
If I'm if I'm honest with you, Steve, I woke up at 2:30 this morning, so that's maybe a bad example. That's a little aggressive.
That's a little bit too early.
I wrote my entire book in the middle of the night. I'm not kidding, right? Uh-huh. But I usually wake up probably about 5 a.m. Mm-hmm. and it just gives me about 3.5 hours to set my own agenda. I don't like to be on my heels or reacting. I like to set the agenda. Okay. Yeah. And so deciding ahead of time what needs to happen, I like to have that time when my inbox isn't filling up, my phone's not ringing, to sort of get my head straight, figure out what I want to do, and just hit my to-do list. And then I also like to just spend a little bit of time in silence. And almost every day I exercise a little bit. I say a little bit. It's I used to race bicycles, and so that would be a lot of it, right? I mean, mm-hmm. So I went from racing 10 to 20 hours a week to whatever, lifting weights for even 30 minutes is enough. and I'm not trying to Hulk out. I'm just trying to get energy for the day.
Of
right.
course.
So, yeah. That's really always been my thing, is that it's like, if I wake up early enough and I have some time to myself, I can kind of decide deep within myself what's going to happen. And that's worked for me. It sounds a little esoteric, but
No, it's something that a lot of, this is episode number 322. And I've interviewed thought leaders from across various domains, and they all say very similar things. Get up early, get your exercise in, give your brain space to just process thoughts and be intentional about the day rather than reactive.
Yeah. The thing is all through college, I actually taught meditation. And I had I had like over 100 students, and I would teach meditation, which to me now, as like a 42-year-old, acquisition entrepreneur, sounds ridiculous. But that just gave me the foundation for, I don't meditate every day anymore. I just don't. I've got 3 kids. I've got 3 businesses. There's a lot going on. But I feel like, finding that silence is something that, I spent a lot of time anchoring in that, long ago. So I felt like it just kind of stayed with me.
Yeah. Well, that's something Arnold Schwarzenegger says. He said he meditated for a year about 30 years ago, and it's helped him ever since.
Yeah, it's like that. It's like that. It's got like residual. I mean, I think the monks would argue you need 20 minutes every day, but it does have residual. Plus, I'm a little hyper these days. Yeah. I try to stay a little over caffeinated and get a lot done.
I'm sure our audience noticed that. Well, look, our audience can pick up a copy of the book at buythenbuild.com, as well as Amazon and wherever good books are sold. They can obviously access that return on investment, return on invested capital calculator as well over at the website. They can hit you up on Twitter at Walker Deibel. Is there anything else people should check out?
For those that want to take the extra step forward, I put together an online course called 6 Months to CEO. If Buy Then Build is the textbook, this would be sort of the college seminar. That's also available at buythenbuild.com.
Awesome. Love it.
Yeah.
Add that to the
Steve,
show notes.
thank you so much. Thank you so much.
Thank you so much. It's been a pleasure having you on the show. And I just hope our listeners learned as much as I did, because this was a really good 1 hour long crash course on becoming an acquisition entrepreneur. So thank you, Walker.
Thank you, Steve.
Hi guys, Steve again. I hope you enjoyed this episode. If you'd like to receive a weekly email from me, complete with reflections, books I've been reading, words of wisdom, and access to blogs, ebooks, and more that I'm publishing on a regular basis, just leave your details at futuresquared.xyz/subscribe and you'll receive the very next one. If you're picking up what I'm putting down, take a minute to like, share, or subscribe on Apple Podcasts, Google Play, Spotify, or wherever you get your podcasts. It goes a long way to giving the podcast the exposure it needs, so I can continue bringing you guests and conversations of the highest caliber. You can catch me on Twitter at Steve Gliveski and on Instagram at TheSteveGliveski. Until next time.
Hasta la vista, baby.